How one trade changed everything. It began with a single move, a trade so ordinary on the surface that no one noticed at first. But beneath that quiet action was a force powerful enough to shake markets, spark panic, and rewrite the rules that investors had trusted for decades. This story matters now because we live in a world where one decision can ripple across continents in seconds. A hedge fund adjusts exposure, a corporation hedges risk, a government shifts reserves, and suddenly millions feel the impact. To understand how fragile this interconnected system is, we need to revisit the moment when one trade, unseen and underestimated, set off a chain reaction that nobody expected. It started with a trader who believed he had spotted a rare imbalance, an opportunity so clean, so compelling, that it seemed almost risk-free. A mispricing between two related assets, a tiny gap the market hadn't corrected yet. He'd seen it before. He'd profited from it before. And this time, the gap was even wider. He built the position carefully at first. A small stake, a test of liquidity. Everything behaved exactly as he predicted. So he scaled up, then scaled again. Soon the trade grew large, far larger than he intended, but the math still supported it. The assets were supposed to converge. They always had. The relationship was as old as the market itself. But beneath the surface, the ecosystem was shifting. Other funds noticed the same gap and piled into similar positions. Leverage increased across the system. Billions sat on the same side of the same idea. If the relationship held, they would all win. If it didn't, they would all fall together. The early reveal flashed when one of the assets moved sharply for reasons no model could explain. A political comment, a liquidity mismatch, a sudden wave of buying from an unexpected source. Whatever the cause, the effect was immediate. The spread widened instead of narrowing. The trader watched the screen with a tightening chest. The deviation was small, but wrong in exactly the way he feared. His position shifted from safe to exposed, and in the space of a moment, he realized the trade was no longer a quiet opportunity. It was a fuse. At first, he told himself the move was temporary. Spreads wobble, prices drift, markets overreact. It would normalize, just give it time. But time was exactly what he didn't have. As the imbalance widened, margin requirements increased. His brokers demanded more collateral. The trade he once saw as controlled and elegant was now dragging him into deeper exposure with every passing hour. The reveal intensified when other funds, holding the same idea, began adjusting their positions. Some trimmed exposure quietly. Others shifted outright, adding pressure to an already fragile spread. Each adjustment nudged the market further in the wrong direction. What had once been a stable relationship between assets was now unmoored, drifting with a kind of mechanical inevitability. He hedged, rebalanced, ran scenarios. But every model produced the same conclusion. If the widening continued, the losses would accelerate at a speed his capital couldn't match. The trade wasn't just moving against him. It was moving against the entire crowd that had bet on convergence. Billions were now tied to a single assumption that no longer held. Then came the early conflict. A large fund, one rumored to be heavily leveraged, began liquidating positions, not out of strategy, but out of necessity. Their selling pushed the spread even wider, triggering losses for everyone else. A feedback loop formed. Forced selling led to more forced selling. The imbalance fed on itself. Phones lit up across trading desks. Brokers raised margin thresholds again. Risk officers demanded answers. Screens flickered with sharp, erratic moves that made no logical sense. Liquidity thinned. Volatility spiked. Yet the trader held on. The relationship had to snap back. It always did. But as the market twisted further, he saw the danger more clearly. This wasn't about fundamentals anymore. It was about survival. Fear had become the driving force, and fear doesn't follow rules. A sudden rumor spread online, a whisper that one of the biggest players in trade was facing catastrophic losses. The rumor wasn't confirmed, but confirmation didn't matter. Algorithms reacted instantly. The assets diverged even further. What should have been a gentle correction had transformed into a system-wide unwind. Inside the trader's mind, a quiet dread settled in. He had built his entire position on history, logic, and probability. But in this moment, none of those mattered. The trade that once felt like a formula now felt like a storm. And every tick of the screen made one thing increasingly clear. The fuse had been lit, and the explosion had only begun to build. The explosion hit with a force that shattered every assumption in the system. Overnight, the larger fund at the center of the rumors confirmed what traders feared. It was unwinding its entire position. Not gradually, not strategically. Completely. The announcement triggered a shockwave that rolled through global markets like a tidal surge. Prices lurched as the spread blew open. The two assets, once bound by decades of historical correlation, now move with violent independence. One soared, the other collapsed. The divergence wasn't just abnormal, it was unprecedented. Models failed, algorithms scrambled, and for anyone caught in the trade, losses multiplied at a speed that left no time to react. The trader watched as the screens became a blur of red. Every safeguard he had built, hedges, offsets, limits, crumbled under the magnitude of the move. His brokers issued escalating margin calls, each one more desperate than the last. To meet them, he sold whatever he could, but those sales only deepened imbalance, widening the spread further. It was a trap, and the walls were closing in. Markets across the world felt the tremor. Hedge funds dumped positions to protect themselves. Banks tightened lending to avoid exposure. Pension funds reallocated in panic. The unwind of the single trade, scaled, copied, and leveraged, was now rippling across asset classes that had nothing to do with the original idea. Currencies twitched. Bond yields swung. Even commodities flickered with instability. The system was interconnected in ways no one had anticipated. The conflict intensified when volatility breached levels that risk departments had considered impossible outside of a full-blown crisis. Spreads on unrelated assets widened as liquidity withdrew from the entire market. Market makers stepped back. Algorithms switched to defensive mode. The structure that usually absorbed shocks had become brittle. Inside trading floors, voices rose in sharp, quick bursts. Some blamed the fund that unwound. Others blamed the central bank for creating the environment that encouraged leverage. Others blamed the traders who piled into the idea without understanding the risks. But none of the blame mattered. The market had become a chain reaction, and every link was under strain. The trader felt the emotional weight settle in his chest. His calculations were worthless now. His strategy, once elegant, disciplined, reliable, had become an anchor dragging him toward ruin. He thought about reversing the trade, cutting it entirely, accepting the loss. But the spreads were so wide, the fill so brutal, that closing positions would all but guarantee the very outcome he feared. He hesitated. A single moment, a single breath, and in that moment, the market made a decision for him. One of the assets locked limit down on his screen. Trading halted. He couldn't exit, couldn't hedge, couldn't adjust. He was frozen, trapped inside the very trade he once believed was unbreakable. The realization sank in with crushing clarity. He wasn't fighting a mispricing anymore. He was fighting the momentum of the entire financial system. And the system was winning. The final blow came not from a headline or a rumor, but from the cold mechanics of the market itself. When trading resumed, the asset that had locked limit down opened far lower than anyone predicted. The spread, the one that was supposed to converge, had become a canyon. And every trader trapped inside it faced the same brutal truth. There was no orderly exit, only surrender. The climax unfolded with a harsh, unforgiving precision. Forced liquidations tore through portfolios. Brokers closed positions automatically to protect their own capital. Each automated sale widened the spread further, triggering more liquidations. The trader watched as the last remnants of his position were unwound at prices that didn't resemble reality. Prices created not by value, but by desperation. Billions evaporated across the financial system in hours. Funds that had been considered stable suddenly faced existential threats. Banks tightened risk controls. Clearinghouses issued emergency margin requirements. The trade that once seemed like a quiet arbitrage opportunity had become a global contagion. Yet as the smoke cleared, the deeper meaning of the collapse began to emerge. The resolution wasn't found in the loss itself, but in what the loss revealed. Markets weren't broken. They were exposed. Exposed to their interconnectedness. Exposed to their dependence on assumptions that fail under stress. Exposed for how quickly a single idea, scaled too widely, can distort the entire ecosystem. The trader sat in silence long after the screen stopped flashing. The devastation was real, but so was the clarity that followed. He saw how leverage magnifies confidence into arrogance, how crowding turns safety into fragility, how markets punish complacency with breathtaking speed. The trade hadn't failed because it was flawed. It failed because too many people believed it couldn't fail. And that belief, multiplied across the world, became the spark that ignited the collapse. So what do you think? Are we repeating the same mistake again?